be good for the dollar, isn't it? Principally, yes. Yeah, it is good for the dollar, but what we're waiting for is people's reaction to it. That's the issue. Okay. And is XRP going to be a BRICS coin? Couldn't tell you, bro. And if it is, I'm getting rid of it. Yeah, so it's, look, Wall Street doesn't know what's going to happen. I hope I do come across as someone that at least has some form of an answer. At least I can give you some form of logic to put together. Some of you that have come into this live stream did not understand why the Aussie yen principle is very important for why the NASDAQ and the S&P could be going up. Now you do. So I know that you can leave here understanding that logic. When you're looking at your candlestick charting patterns or whatever softwares, algorithms you're using and what have you, you've now got fundamental logic to put to the test. You can now take whatever service you use, whatever indicator you use, and say, okay, the MACD, for example, is moving up. Okay. Can I justify that from a fundamental perspective? Well, Aussie yen is moving up. The dollar's going down. The Japanese yen is moving up. Interest rates are high in the dollar. They're looking to cut them. So it looks like dollar's going to end up getting more cheaper. That could then suggest the idea that Aussie is going to keep on climbing up. Aussie yen principle suggests that they're going to keep on buying Aussie and converting it or using it to buy assets. NASDAQ and S&P should be going up. That's the logic. That's what I think is going to be happening. So that's how you can use it. Can you start using CoinAnk for order flow, please? Well, I do use CoinAnk for order flow. I do look at it. What I look for with CoinAnk itself, ladies and gentlemen, is I look at the relationship between bids and offers. Who's buying, who's selling, okay? So just to put it into perspective for you all, okay? Iron, hold tight, my bro. So, look at this. When you look at the order flow, right? And this is for people that ideally for holders, okay? And you really want to have a good idea about Bitcoin's behavior. Now, I haven't got the historical data on there, but when you look at this all the time, you start to get a feel for the type of concentration of commitment. That means how many people are buying, how many people are selling, right? If you're of the belief that when prices are going down, it's because people are selling, you're focusing on the wrong people selling, okay? You're focusing on retail. We're not interested in retail because in order for retail to sell, someone has to be there and be like, I'll take that. Thank you very much. You want to pay attention to those guys, okay? So you can see that there's been a high concentration of buying in this area. We've now seen a high concentration of offers coming into play, which is this pink stuff. We've now got even more of a concentration of offers coming in. These are the people that are prepared to sell the Bitcoin right now. 18 million at 70,000, okay? Let's go and closer look. In front of you here, we have got 1.8 million at 62, okay? That's not enough for me. 8 million at 62,380, okay? Inside here, you've got 1.5 million at, 7 million at 60,850, okay? And then you've got this order right here of 3 million at 60,000. So let's look at this. That order is still there at 60K, all right, just below 60K. It seems like Bitcoin is stalling at the point of control. Most of the contracts are right there. There is a potential for Bitcoin's value to change because you've got 3,073 contracts right there, which is only 1,500 contracts more than the actual point of control, but only 1,100 contracts more than the point of control. In other words, value can change at any moment. Look, change at any moment. Look, 3,818. So just shy of nearly 300 contracts more traded at the 59,990 point. The point of the VWAP, the point of control could adjust by nearly 800 contracts, okay? There or thereabouts, all right? That tells me value's changing. And if value changes and moves up, then that tells me people are in agreement to pay higher prices and be a happy medium from those points. These are things that when you look at this, you're getting an understanding of intention of how price can move. For those of you that are new to the live stream, go and watch the last few live streams where I've shown you my trading on the NASDAQ and the S&P. These are the logics that I'm putting together. I use exo charts, I use depth of market, I use the hybrid system, and that's my main focus, okay? on what I'm doing there. Ladies and gentlemen, bear with me a second. We'll start again. It's all good. No worries. Okay, then. So back to what we were talking about. Take it back. So we've got 15 minutes until the action starts. I'm not going to change the toilet. No, I'm not. The toilets. That's not the toilet. That's not the toilet. It's somewhere in the house, man. Something like that. But anyways, why are we talking about that? Any other questions? Okay, Tino, leverage is probably the worst thing that has happened to crypto. Inflated prices everywhere. Well, listen, it's because people aren't really using it properly, you know? People aren't using leverage properly. They get excited. Leverage is bad. It is bad. But if you use it properly, don't borrow too much of their money, okay? Keep it as cheaply as possible. Any other questions? Because we're going to get ourselves ready for the next 15 minutes, ladies and gentlemen, that we're going to hear the data coming out. Bank of Japan announced they considered the rate hike, but they don't mention when. Do you think, but they don't mention when. That's the thing with Japan. Do you think that they will do it immediately after the FOMC? Maybe too much volatility when this event is near FOMC. They don't care about when they decide to effectively put out the interest rate. Okay, that it doesn't matter for them. Okay, ultimately, what they've got to look for, in principle, is they have to be looking at where they are in terms of commitment on the Japanese bonds market. Okay, if the bonds market seem to be sustainably going up in their favor, then that means they're keeping the yield lower. And then the lower this is away from 1%, because if they do get to a yield of around 1%, then their GDP output is doubled, which makes it harder for them to really profit from doing business with the US. Okay, that's why they want to inflate the actual yen itself, because it's been deflated for such a long time, ladies and gentlemen. Look how much you can get on the yen, you know? Look at it. It's horrible. It's been look at the last 7 months, ladies and gentlemen. These are 7-month candles, okay? Each candlestick is a 7 months, okay? It's just badly going down. It's no good. And they need to do something about it to sustain their economy. And as they are the largest holder of US bonds, okay, it makes it easier for them to really play around with the carry trade. They know everyone's using the carry trade. They do the carry trade because remember, Japanese authorities had told all commercial and all corporate commercial companies in Japan, get rid of any dollars that you've got and turn it back into Japanese yen. They directed all of the companies, corporate companies in Japan, to get rid of their dollar risk and convert it back into yen.
rally off that. Small caps would like that a little bit.
I like the look. They're going to plug in these AirPods, although I think they're pretty fully charged. This is the update right here, 59.41. So we won't get any more closer to 50-50 than this probably. Yeah. So I would say, like, if you hear half a point, I actually think the market sells off, which is why I'm short right now the NASDAQ. And I think if you hear quarter a point, then I think we have a potential to go continue a little bit higher. The reason why I think that is they've been pretty steadfast in what they've wanted to do. And I thought that, the talk was, looking at quarter the whole time. And I just, they were gradually going to start to cut it. I feel like if they do 50, that's more than gradual. So that might spook the market. I don't know. I don't know if they're late, if they're early. At the end of the day, we just trade, and here we go. Now we're short, so let's see if it works out. We had Brian Shannon on. We've had many different heads come on and talk all about where they thought this rate was going, where they thought the market was going. And you know what? At the end of the day, the S&P's at all-time highs. Everything's at highs. So from my experience on Fed, you get a move down. Powell comes on, talks all dovish, you get a move up. Powell leaves the podium, you get a move down. It's been pretty much like that. You guys remember a couple of times ago, maybe even last time where we had Apple, we were just waiting. And I was like, when is he off? When is he off? When is he off? And then we were layering into the short. Then all of a sudden, and it's about a half hour or so, boom, goes a dynamite all the way to the downside. So we'll sit in these queues. We did get stopped out there. We just went once it broke 67, and then I realized the high of the day was 67.08. So we had a little bit of a short there, took some profit, got stopped out of a little bit, and then just realized, hey, let's try to get something into the short side as we get ready for the close, for the release. So now less than 10 minutes, 59% to 41%. As Brendan and Neil both mentioned, it's been 4 years since we had any kind of a cut and any, sort of a decisive shift in Fed policy. So the cut, Brendan had that stat. I don't know if he still has it. And that was that bar chart that showed the market after cuts. And it was more positive than negative.
Yeah, and the strongest were utilities and it was utilities and something else were the two strongest in the 4 months after, I believe it was. After. I'm going to quickly ask this for you.
I just want to tell a tool there in the chat. Thank you, Sebastian, for that talk about. He just says, will we be providing live updates on the Fed?
Oh,
yeah. Yeah, very much so live. There's no other place, Atul, that you're going to see live NASDAQ quotes right on the screen as the Fed drops. Plus, we have Brendan on the desk and Sharif on there analyzing the written and spoken word when Jerome Powell comes.
Yes.
There it is. Yes, bang, let's go.
He'll say a lot.
Here comes a nice little move down in the market. We just took a little bit of a bid. All right, Neil, what were you going to say about the 8-ball there?
All I'm going to do very quickly is I'm going to ask 8-ball. I'm going to ask it because right now it's favoring 50 points. So are we going to get a 50 basis point cut? Shout out to our friend and viewer, Mr. Westermeyer, for the custom 8-ball that says, why not ask Perplexity?
It's true. I mean, you might as well. I mean,
if I ask Perplexity, it's just going to give the answer that we already got. So thank you for the 8-ball.
Yep.
ChatGPT is just going to simply say 50 basis point cut because that's what the odds are favoring. So the 8-ball seems to think we're going to get 50. I think they should do 25, but should and
poll?
Will are different. Yeah, we should have a poll up there. You know what? We should have when people just throw ones or twos, with 2 being 50 basis point and then 1 being 25 basis points. So in the chat, just throw it up. If you think we're getting 50, just put a 2 in there.
Do a poll. You're right. Let's do that for now.
Let's do that really quickly because we only have about 7
minutes.
There's only
8 minutes left. All right.
Fabian is doing a poll.
So right now, we're short, right? I mean, we could talk about this. I'll probably be trading the futures, maybe not individual names, but let's take another bid out right here at 50 on the TQQ. So we are short right now, the NASDAQ. I don't want to be in this forever there. 1s and 2s everywhere. We'll get that poll up there where we can. It'd be kind of cool if we could just automatically tally all of those. But great idea there to get the chat going. A lot of 1s. Do you remember what 1 was?
It looks 1 is just a simple 25 basis point, and 2 would be.
Yeah. The poll's coming up.
Oh, it's a lot of 1s.
I like all the action in the 1s.
A lot of 1s.
All right, so we're getting out. So again, if it's 25 basis points, I think the market holds course. It's been rallying the last couple of days on that expectation of 50 points. So I don't know. I'm kind of like back and forth with what the market will do. But the best part about it is we already have our stop at the high of the day here for NASDAQ. If that goes out and comes through, boom, we're out of there. We have some bids lower. So if we're right and the market comes back in, we should get swept up on those bids. I'm looking to trade this. We're in it right now. That's my plan on the TQs. I think it's a foolproof one, man. We could easily. I think the risk to reward is right here. Like if I'm not willing to risk right now 40 cents and get, or not even 40 cents, and get out at the high of the day for what I think could be a huge flush down $1 and change, I mean, I'm in the wrong business. So let's wait to see what winds up happening here. We're in it right now. I like the odds here. I'm going to select.
We're the exact opposite of the money markets.
I'm going to, yeah, exactly. Yeah, it's funny. Yeah. I'm going to select 50 basis points right now. Is it 60-40 the other way? So here we go, man. That should be a good one. Thank you, everybody, for filling that out right now. So, all right, let's go, man. 4 minutes left. Any other thoughts on the desk, I guess, before we go? There's only 5 minutes now.
We were just talking about going back to when this whole cycle started to the upside, how things got rolling. And if you remember, I just had to double check because I couldn't remember. But on the upside, I mean, this has no correlation, but on the upside, it was a 1/4 point first, and then we went 75-75, then 50-50. So, I mean, it wouldn't be the first time, but I mean, I think he's shown that he's willing to be cautious and patient here. I mean, they're already, depending on who you talk to, they're already behind, if you will, in this cycle. So it's really a toss-up, I think.
And that's the thing, right? So does he have the thinking mentality where, hey, let me do 25. If I need to do 50 next time, I have the option of doing 50, because that's kind of what I felt he did first time around. I think we were printing a 6 or 7 handle when he did that 25 bips. And so he kind of gave himself the option.
On inflation,
exactly.
For anyone wondering. So whether or not it's going to be 25 or 50 remains to be seen. But guys, I think the more interesting aspect is here, and Sean, I mean, I just said to Sharif off camera there, I like the short. Is there a scenario, can you paint the narrative, you know, for the positive side here? Like if it's 50, you can start talking about, you know, maybe the economy is not as good as everyone's thinking, and therefore they need to hurry up with this to, you know, smooth the landing out. But if it's a 1/4 point, is that enough at this point? So is there a positive narrative?
To 50?
I mean, no rate cut might be positive. No, I see both sides downside. I mean, we just talked about that. I'm looking at the market. I'm looking at what the Fed's going to do. What's their mandate to try to have a soft landing? Well, I mean, we have full unemployment right now. We have inflation that's coming back down, you know, into a level that they've talked about is accommodating at least. You know, the dollars and a little bit, you know, protection to the downside.
Move from here. Tina, will you be as great as I mean, I'll live longer than Jesse Livermore because he killed himself over his wife. So I think it's about just don't have a wife and then you'll live longer. Is that not the case? A monetary roller coaster will start with the Fed's probable decision to cut interest rates on today and finish on Friday with the outcome of Bank of Japan's meeting. That's exactly what I'm waiting for. You know, I'm waiting for that. Tino is Italian. I'm Greek, man. Come on. All right, ladies and gentlemen, we've got 4 minutes. Let's do a check. 1,600 likes, mad love and respect. 3,500 of you passing through to the live stream. How many of you are new? How many of you are new to this live? Because we're going to be getting the PAL flavor coming up very shortly, ladies and gentlemen. He's waiting. He's waiting. I'm waiting to do that. No cut would be fun. It really would. No cut would be pretty exciting, to say the least. It really would. I'm shorting. Oh God, who's playing shorts? You're new. Welcome to the channel, ladies and gentlemen. If you are new, I know I've been making reference to a lot of things on here, so just get over to tradersreality.com. It's pinned to the top of the chat, and you'll get a little bit of flavor about what this live stream is all about. I'm consistent with my lives. I'm always bloody live. I'm always talking about this not job of an asset, but we do focus on other assets like NASDAQ, S&P, and the importance of it, as you've seen this evening. And we ain't even into the FOMC itself. We're going to see some flavor very, very shortly, ladies and gentlemen. So I'm looking at NASDAQ. I really want to take a trade, but I'm not, because I have to be very, very focused. I just think we're going to see some wild behavior very shortly. Bitcoin hasn't even been able to take the daily open. So if you are new, trying to make sense of the madness which will be unfolding in the next 2 minutes, get over to tradersreality.com. and go take the free course. There's a free course on there on breaking down the hybrid system. It's only an hour. You've been here for an hour already. I've been telling you how I use it. This will tell you how to use it, okay? And break it all down for you. You got to be a bronze member so we get out all the spam and what have you, but it has its worth its weight in gold in helping you understand this system that I use, the hybrid system, okay? So go tradersreality.com. It's pinned to the top of the chat. That's actually the platinum membership where you get way more detail, trade setups every single day. So go and check that out. And you get a Discord community as well, where those guys are monstrous traders. They do all this stuff all the time. And very good traders in there. All right, then. Tino, do you think we're going to the moon or we're going to hell? In a minute's time, ladies and gentlemen. Then we're going to be looking to see if these orders up here are very important. I want to know if they're spoofs because they could get pulled. But we're going to see it very, very shortly. I've got NASDAQ to the left of me. Whoa, where's NASDAQ gone? NASDAQ is currently trading. Okay, yeah, there's spread on the futures markets. There's a spread on the futures markets. Are you serious? There's a spread. That never happens. It just goes to show how crazy price is right now. Whoa, 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 whoa. Where's NASDAQ? 1312, 71970. Look at the price differences, how they just... Very, very choppy, guys. Very choppy. Here we go. Here we go. Are we going to see it? Here is the flavor for Bitcoin. 60,700. Oh, come on, Bitcoin. Just do something. Are we going to get that cut? What is the cut? Here we go. Oh, not liking that. Oh, look at it. It's crashing. Look. Here we go. They're going to eat. Look, it can't keep up. It can't keep up. Look at that. Here we go. Look at that. It can't keep up. Unbelievable. It can't keep up. It can't keep up with it. Look at that. Not even TradingView can handle it. Come on, son. Come on, son. Look at that. Look at that, ladies and gentlemen. Welcome to the madness. Well done, ladies and gentlemen. We've come to a massive... This is before the live stream itself, ladies and gentlemen. Okay, we got to wait for the markets to just chill out. NASDAQ, I can't even... I mean, look. How are you going to trade? How are you going to trade that? How do you trade that? Gaps in the spread. Like, how am I going to take a trade on that logic? Can't do it. I will get outfilled. I'll just get bullied. Well done, Bitcoin. They've eaten the liquidity, ladies and gentlemen. That's wonderful news. They've gone for it. Look, it's up there. It can't keep up. And we ain't even got the press conference. So I'm going to go and have a look.
$3 up.
Yeah,
IWM. I mean, it's look, it's going to move like that.
Nvidia's $3 up. Yeah, wow. Good call on that one, the IWM. We are long right now on Apple. We just took a bunch of pieces out there. Let's see what winds up happening. The fade play could come in, but I don't want to fade anything right now. Nice move back up there to the upside as we go. Look what just happened to us on the TQQs. Really, like, we get a 66. We got a bunch of, remember we were layering our outs? Like, that was huge. We were out. We got back in and out again on that futures play. But here comes the market right back in. I'm long down here. We've already been long down here. Let's see what winds up happening. Nice little retrace back. We have less than half of these shares. We'll try to reload a little bit down here.
Oh, man, ladies and gentlemen, be very careful right now.
Points, and we're in Apple.
Be very careful.
It's been a good trade so far. Let's see where we go. What's up, B?
Individual data points don't really matter. What we need to know is on the projection side, guys, they're all to the downside. So 1, 2, 3, and longer or 5 year, all to the downside.
Ladies and gentlemen, that is absolutely phenomenal.
Futures market
Are you
pricing
kidding
in 100
now?
basis points.
So that effectively, look at the order book itself. You can see it's just not being able to keep up. People are going crazy for it right now. Okay? Even TradingView just looks a bit laggard. First move is the fake out. That's correct. It is the false move. First move is the false move.
Right now.
But it's so important that we've effectively had this rate
even
cut
on
itself.
These futures. I'm just looking at Apple.
Massively
I have
important.
targets here, 222. We'll get a piece out. If it gets back up there, then we'll try to hold the rest.
It gives us the scope that in the future we could be close to a whole point.
The cut cycle now, right? We talked about that, how good that's supposed to be for markets.
So
let's see if it is good or not. Where's our target to get out? Maybe a 221 break.
Want to do
That's the
it, but
50 period moving average. We got to be smart about that. So let's watch out
Anyone
here.
looking at the
and
depth
not try
of
to hold
market
forever.
right now,
Just try to trade
you can
smart.
see straight
so
away
far,
it's
so
not
good
stable at all.
on the Fed. 50
It
basis
is not
points.
stable.
We get what
at
we
all. Let's
we
just
get
quickly
what we
go over
thought
to
we
the
get
order flow
there.
over here.
I know
So
there's
it's
some
much
people
more
talking
smoother
about a
here.
quarter.
You can see
I know you
right
thought.
here how
I thought
Bitcoin
that
is
was going to be a
behaving. It's
quarter.
gonna
That
take
was
out
more
those
along the
previous
lines of
zones
just
on
what
the
I
initial
thought you should
balances in
do
principle.
and what I think
Okay,
doesn't
well, not
matter.
just
I
yet,
mean,
sorry.
you know, these
We
guys
zoom
are
out.
actual
This is all
economists,
because
so
we've got
that's
that
what their
point up
job
there,
is. Apple,
63,000.
look, we're
That'll be an
bouncing
ideal
off
story for
221 in
us.
here.
But
Let's go
you've
back
got
to
be
Brendan.
careful,
What do you
guys,
have, Brendan?
because
Real
50
quick, as
basis points,
expected,
if
a
we just go
lot
over
has
to it right
changed as
now
far
and
as the
what they're
statement
saying
is
about
concerned. So
the
anything
statements.
that's
So just go to
read
the news a
essentially is either.
second. We'll see some guys on X coming out with some information. Okay, so here we go. Not really saying anything. Okay. Vote in favor of 11-1 with the Fed governor bowing, dissenting. Bowman preferred 25 basis points. So 11-1. That's awesome. Okay. So the majority of the members of the Fed were like, yeah, well, we need to cut. Okay. FOMC has gained greater confidence in inflation moving sustainably towards 2%. Judges risks to employment and inflation goals are roughly in balance. Okay, we will carefully assess incoming data, evolving outlook and balance of risks in considering additional rate adjustments. Here we go. Here is this discussion about the statement when they pull out keywords. Okay, so here it is right here, if you can see. So we have got moderate slow. Job gains have been moderate slowed, okay, eased over the past year, but remains somewhat elevated in recent months. So removed, added. So these are the words that have been added and taken away. So what do you see? They've been adding. So we've got, well, it seems like a fair distribution of adding and removing, but looking at the words that they're adding and removing, you know what? I just need to go back into the chart. It's pulled back down again. Okay, so we've got to be very careful with this. Where are you at, ladies and gentlemen? This is all before the press conference itself. This is unbelievable. All before the press conference. Tina, will you show Powell's speech? Of course I will. Got ready for you right there, ladies and gentlemen. And we're going to have exo charts at the bottom down here. We're going to have the chart in the middle. And we're going to be listening into what Powell has to say. And that's coming in very, very shortly. 25 minutes time, ladies and gentlemen. 25 minutes time. How many of you are in the live stream? I think we've hit a record, ladies and gentlemen. 4,522 people in this live stream. Mad love and respect to all of you. Thank you so much. Honestly, thank you so much for tuning in today, ladies and gentlemen. And we ain't even there yet, man. We ain't even there with Powell. And it's going to be very interesting to hear how they are going to work with this. But like I said to you before, be very mindful, okay? The Japanese 10-year right now has shot up in principle, okay? It has moved up. This is a 9-hour chart, but it's pretty much back in the same spot, okay? The yield has come up a little bit, okay? That's not a problem, but the 10-year bonds is doing, where's the volatility index? It's come down. It's come down. It's wonderful news. Listen, man, I'm really pumped about this. I'm really pumped about this behavior on Bitcoin. I'm really pumped about it. Really good. You know? How many of you are actually playing this? I just want you to understand this, right? Look, I'm prepared to take a trade right now just to show you at why it's not sustainable. I'm prepared to lose money on it. Okay? Look at the way, okay? So let's just look at the way it's actually, you know what? I'm not going to do it. Look at the price, the yellow bar. I can't even keep up with it. Okay? The yellow bar in relation to the bids and the offers. Look at the gap in between, okay? It's going to tell me straight away that I could be down like $700 from the second I open a trade. From the second you open a trade, okay? Now, the S&P is moving relatively decent, okay? But just even one contract, it's like just to show you the volatility. This is all before it. So if I just wait a second. This might be a very, very interesting thing if I go to the 30-second time frame. Let me see if it can happen on the S&P because it's very. I've got the gap down there. Try and take advantage of that. Yeah, I'll take 200 ticks on that. $337 just then. Happy days. Not bad. That's a quick scalp. Before I could even tell you the trade was on, it was a quick scalp. Happy days. $337. I'm cool with that. Just on price going down. Can we take advantage of another move? Keep going. Come on. Mark lower. Go down to the vector candle recovery. Off she goes. Keep going. Keep going. Go, go. There she goes. Okay, we got to hurry up. There we go. 27 ticks on the NASDAQ. Where we at? How much have I made there? 28 ticks. I'll get out. How much was that? Oh, so it's $300. So $612. Okay, I'm finished now. I'm not going to trade that anymore. No, thank you. No, thank you. My heart is racing there. No, thanks. I'm not. No. That was on the S&P. If it was the NASDAQ, it would have been a bloody nightmare. But that's what literally the logic that I was trading just then, ladies and gentlemen, on it was Bitcoin or S&P. Was I looking at Bitcoin or S&P just then? Was I looking at the S&P just then? Yes, I was. Yes. Yeah, so the S&P, trading the logic of, this is the 30-second time frame. I'm going into vector candle recovery points, okay? And just purely off the way the depth of market was working just then, okay? See, the S&P moves slower than the NASDAQ, but it's moving very fast right now, okay? And that's how I trade. But it's moving so slow in comparison to a normal trading day, okay? So slow. Sorry, it's moving so fast in comparison to a normal trading day for me. Excuse me. You see, the S&P, 10 ticks in the S&P is worth, in principle, 30, 40 ticks in the NASDAQ because it's more volume, right? And it takes a lot of volume to move it. But the NASDAQ, it doesn't. You can have like 5 contracts and people are like, oh my God, contracts on the NASDAQ. But 5 contracts on the S&P, you carry more weight with it, okay? But this is why I trade the futures, because we can take advantage of these key opportunities when liquidity is flowing. Look at the vector candle. They were going into, they came down to it. I started to see it. And this is not me at my station. When I've really got everything up and going, I can pull those off all the time. You do lose money and you do make money, ladies and gentlemen.
The market's kind of just blah right now. It's waiting.
Blase.
It's waiting for Powell to get on the stand there, take some questions, and figure it out, right? So that's what I'm waiting for, and I think that's what the market apparently is waiting for also. So we'll stay relatively light in this and see if we do get a flush.
Yeah, exactly. I think that's just go station to station. Usually I like trend after 2:30, generally speaking. So once you get like that opening move, I'm starting to think, okay, well, scalp some levels if you can find them. That's why I went over to a firm for the 45. It lost 45, shorted 80s, back into the bottom end of the range here. And then I'll try and rinse and repeat this off this 45 level. Again, I really would have thought this would have broken out the top, but for a couple of weeks now, a firm at 45 has just been a brick wall, as you guys can see here. It tried to break out and flushed. So if the market's going to come back in, why not pick something that failed the top to short here for some relative weakness? So I'm going to stick with that. I was looking at a couple of other names as well that I thought might be moving around on this. Rivian in particular, that is real, and it is a spectacular wick that hopefully nobody is caught in. But Rivian's another example of a weak stock that failed a breakout and failed it big just now, which was trending down. And this low of the day here is essentially the biggest low you can have. It's like a flat bottom break here on Rivian. So I'm going to favor shorts in a firm and maybe Rivian as well.
That's it.
Debate on this consensus breaking, right? Let's write this down and be very clear about this. This is the first time since 2020 we've had I think we're at over 2 years. Hold on, I have this. Okay, let me see here. Consensus. No. Unanimous. Okay, let's see here. No. Dang it. I want to say it's the first time since 50. Oh, here it is. No dissent in the last 2 years. right? So this is the first time we have a descent in the last 2 years. I really want you to think about that. First descent in the last 2 years. And that's Bowman. Bowman, who wanted 25 on 11 to 1. So what does that signal to you? It signals that even though Jerome Powell prides himself so much on consensus, he couldn't get it. First time since 2022, 2 years, that we have not had consensus. Bowman, who really just joined the voting committee anyway, Bowman couldn't go for 50, stuck with 25. And what that does is it tells you they don't really know. They don't have agreement on the state of the economy, right? So no agreement on state of economy. In uncertainty, they are hedging against recession by going 2020 or by going 50. This is somewhat bullish in Kevin's world, but markets may see it as worrying or worrisome, right? And so this is, again, where you think profit taking is possible as people sort of let the dust settle and just come back closer to the election. You know, that's kind of what my fear has been. Let's see. I want to see. I mean, the dots here are just visual representations of what's on this chart. PC inflation. Inflation's really one here. They do not see any pop-up inflation at all. In fact, if I go to the March statement and I look at the PCE trajectory, you could see that they thought you could go up to 2.5% on inflation. Now only 2.4, right? So I'm going to say down from 2.5 in March 24 SEP. It's just useful to have those little notes here. Okay. Oh my goodness, I hear screaming children. I have a lot of children, so I'm going to close the second door really quick. Let's just listen in here for a moment.
We're almost guaranteed.
Somebody named LOL says Kevin's coping, rip his shorts. How many times do I have to say I don't have shorts? The only shorts I have are the shorts I'm wearing. You want to see my shorts? Maybe I'll show you my shorts. I mean, maybe there's some ladies who want to see the shorts. But no, I don't have any shorts. A little tiny exposure to a short Bitcoin position. But no. I actually have call options. You know, I have like $2.5 million of call options that I think will do exceptionally well with a 50. Just give it a few days, and they'll do exceptionally well with a 50. So no, I don't have shorts. Yeah, show us the shorts. I'll get a child first. Hold on, let me put this on.
Right now, about half the curve is above where it was yesterday on the close, meaning 7-year, 10-year, 20-year, 30 years or higher, but it's starting to creep down the curve. The equities have given up some of the ground, and the interest rate complex first initial reaction was a rally pushing yields down. Then they bounced back. Now they're coming back down. It's going to be a big two-way trade probably till Q&A. But what you really want to pay attention to is the yield curve. Right now it's steepened about 5 basis points, meaning long-term treasury rates are a little more stubborn in terms of coming to the game and rallying, pushing yields down. And ultimately, if you listen to our panel, pretty much every guest we had on today, you know the good side of what the Fed did. But the other side you're going to hear a whole lot more about in the next 15 hours. 50 basis points.
Yeah. Okay, Rick, we'll see a lot. So I want to introduce everybody to my Jay. This is Jay. He's a big boy. He's our biggest boy. He's got this funny face with these giant cheeks. But he's so cuddly, and he's a happy little boy. And his name's Jay. What's up, Jay? But anyway, he's here to keep you company for the next 13 minutes. Well, maybe he won't last 13 minutes, but he's here for a little bit while we wait for Jay Powell. And yeah, it's pretty crazy in here, huh? Yeah, huh? So he also likes Luigi. And what else do you like? You like food. This guy eats. This guy can eat. He's the biggest. This guy is just as big as the other babies that we have that are about 5 months older than him. So it's kind of crazy. But anyway, let's keep going with this statement over here. So the statement, like, I want to see what else we have. Fed. Federal funds rate. You know what I'd like to do would be we'll look at a red line in just a moment of the actual statement. Actually, you know what? Maybe we should do that. Let's go to a red line. The red lines are always interesting because then we can see, you know, just the various words that were changed. I can usually get those pretty quickly. No, nobody has a red line out yet? Are you serious? That's crazy. That's fine. But we read out the statement. I will see what has changed here in just a moment. I want to see what the suits are saying. It's good that the Fed has now recognized the weakening of the labor market and responded with an aggressive cut. Given that there is almost no risk of rekindling inflation, the greater boost to the labor market is, let's see here. The greater boost to the labor market is largely costless, will help spur the housing market. That's true. Could help mortgage rates here. Yield-driven dollar bearish narrative has dominated since it was validated by 50 basis points. Yes. Let's see here. As we noted earlier, markets were quite divided. Just 9 forecasters out of 113 at Bloomberg economists predicted a 50. Boom, baby. Your boy me Kevin was one of them. Well, no, I'm not an economist. Maybe I should go to school and become an economist. I've taken a lot of economic classes. I love economics. But anyway, yeah. What do you think, Jay? What do you got? 50, buddy. You gave us 50. Huh? Yo, you think that's funny, don't you? 50. Yeah. So, okay. Let's see. Pretty one-sided. Huge victory for Jay Powell. Kudos are already coming in from Democrats, many who have been calling for a bigger... Oh, I can't wait to see what Trump says to this. That's going to be funny. I'm going to go to Truth Social really quick just to see if there's anything from Trump on this. Nope. Nope, not yet. It's been like 16 hours since he's posted over there. But statement is clearly dovish, stating risk in the economy, switching from inflation to employment. Dots look interesting. That's fine. Tweaks to the language include job gains have slowed, okay? Says inflation has made further progress, but remains somewhat elevated. Statement says committee has gained greater confidence that inflation is moving sustainably towards 2%. Statement notes risks are roughly balanced. Yes, indeed. Roughly balanced. Huh, Jay? So we got to make a bingo card now, okay, Jay? All right, Jay, man? You're such a jerk. You look at those smiles. His cheeks are so huge. Those giant cheeks. Okay. Let's see. Somebody's saying gold running. Bonds are roughly flat. Oil slightly down. Gold up another %. Nice. And then let's see what they're saying here.
Welcome back. We've seen whipsawed markets after the Fed's decision at 2 p.m. to cut interest rates by 0.5 point. The Dow had been up to session highs, all-time highs, in fact. Briefly turned negative, is up 188. S&P's up 0.5%. NASDAQ, the highest, up 0.8 or so. For more on what investors need to know, Mark Avalone is here. He's president at Potomac Wealth Advisors. What are you advising, Mark? Welcome.
Ooh.
Well, welcome.
Yes, what are you advising?
It's a big surprise for me. And
Yeah.
I think investors shouldn't go out and make any knee-jerk responses. But I think there's going to be some opportunity here. I mean, we've talked about the relative valuation differential between small, mid, and the large cap, mega cap. I think a lower rate environment is going to serve small and mid cap well. So that allocation, still not too late to get there. Again, it's literally about 50% on a forward PE of what the large cap, mega cap is. So we find that attractive. We also think investors, whether this is a slowdown, 50 basis point cut, or a preemptive, we want to get out in front 50 basis point cut, we think technology is the way to go. I know I've been a broken record, but...
Buy tech! Oh my God, another one of those people. Everybody, quick. I got NVIDIA.
Okay. Tino, doesn't 50 basis point cut give Japan a better chance to increase interest rates and make the carry trade take place? Yes, it does in principle, because when you look at it, okay, look at the 10-year bonds market. It's moving up right now, okay? So people are going into low risk and they're going into high risk. At the same time, the value of it is just terrible. There's no point in holding dollars right now. Would you buy Bitcoin with your dollars right now? Naturally, you'd think that would be the case. Excuse me. You think it's better to go into Bitcoin because my dollars are deemed worthless right now, but you're not really picking up that much Bitcoin. Forgive me. What on earth is in my eye? Oh, my days. So, yeah, it does make sense, you know. But we didn't get our 80K projection before 8 o'clock. And it's not 8 o'clock just yet, but my logic was, you know, I wanted to see it go 7 weeks ago. I wanted to see it hit 80K before the 8 o'clock FOMC press conference, but we didn't get it, ladies and gentlemen. I was wrong. Okay. It didn't even go anywhere from the time that I said it was going to go up from it. So technically, I can add another 7 weeks, can't I? Because Bitcoin is at the same price that I said it would go up from. So am I right or am I wrong? I'm joking. I'm joking.
This was a name that he thought could go, and there it goes right there up to 124. Great call on XHB. Let's have a quick little look there on GLD. And of course, we're live trading.
Thanks a week.
You know, we're day traders. So all these kind of plays that are happening right now, is that a gift for me there, Fabian? Everything that's happening right now are probably good for longer term. Look at gold now breaking out again. Gold likes that number. Bitcoin likes that number. Bitcoin right now making that move up. I mean, everything really starting to go, man. There goes NVIDIA again. It is not another one, but it is one of them. NVIDIA trying to go again. We just sort of wicked up there into the 70s. Let's see if we get back to highs. Man, we're having a great time. An absolutely great time here today, once again on the show. Palantir to 37. Oh, hell yeah.
Oh, yeah,
Palantir goes to 37 and comes right back in. And look where it comes right back into. Past support. I mean, this market, you're rocking with me, so hopefully it's all good. But let's just wait to see what happens here as the market gave you support and resistance. So depending on what you're looking at, you could have had it. And there it is again. It's NVIDIA. Cha-ching. The cash register now goes $1 into the money, back up there to the upside. We talked about where our stop is. Let's just see what's going on moving forward now. Good day. Good day.
Yes, sir. Good day. Still going to the upside. The NASDAQ is, look, we're still trying to break out those highs. You mentioned Palantir. Ooh, that Palantir has double barrel because it's going into the SP 500 on Friday. So there's probably going to be a bunch of buyers in there. We're trying to retake these previous highs. As I said, I'm not chasing. I'm glad I didn't compromise. I could easily have gone right back into a firm. Like it gave you a short setup off the lower high, only to now break it back out and retest 45. The setup was fail the 45 level, not just sit out in front of the 45 level and get run over. And it feels like it does want to run you over a little bit. End phase might just be too far gone at this point for anything but like a 125 break. So I wanted it off of 122. A little bit spreadier than I was expecting over on them. And the other one you can look at, if you're, as Sean mentioned, you can look at TAN. I think maybe a little bit better. But end phase, a little spready to my liking. What I don't love here is Apple sort of pulling back when everything's back at the highs, which is not what it was doing before. So Apple kind of failing 222 here and dipping back in to what I think should be support where it was before. It's shown you the levels. That 220.5 is the level. I think if we're going to bleed back into the market, that's where I want to get to. A firm is breaking 45. The only way I want this back on the south side is for it to fail this breakout, trap some longs up there. We got about 3 minutes till he gets on the podium. Powell, generally speaking, I want to wait till I'm not in it in the next minute. Then I definitely want to wait until Powell hits that podium to make the next opportunity in there. So we'll see if we actually get something in Apple on the dip. A firm just went over under at the 45 level. So there's the
Here it comes.
There's the push over 45. We wait for it to break. It broke. It comes back underneath. Got 91s in there on the way back. When it gets them out where it crested the last time, support was at 70s. And then have a look at VWAP. If VWAP holds, jump out of Dodge. Remember, the market's going up here. So this it's a counter trend trade on this failing 45. If it holds VWAP, gonna get the you-know-what out of Dodge. As Apple gets really close to its support level as well. So Apple, I like around VWAP, 220.5 or so, and we're into a firm off this 40. It's not doing that big of a dip. Little surprising there for Apple. I don't know. I'm not liking what I see there. So we try second time. Patience, patience, patience on a firm. I was down on a firm early, got it back, and was up, and now I'm flat on the stock. But it's all about waiting for that price area. This was the level I liked.
Boom.
Probably could have had a heck of a lot more. Now Apple's starting to go. All right.
All right, guys. Yeah, so kind of a muted thing here. I was just looking. Some of you asked, about how things are going. I think the office was pretty much down on that number, but there were some good trades. So depends on what you were trading for sure. So that's the beauty of a prop floor. You're gonna have some traders that can do it. Some traders make money. Some traders lose money. At the end of the day, you just hope to be net positive. So. And that's what happens, man, when you get that going. So, all right, NVIDIA now $1 in the money here. Neil's long Apple. Obviously, we just talked about getting out of that Affirm. And then now we're going to watch out to
Put it, though, by suggesting economy strong now. I got three more. Give me three quick ones. Quick. We got 30 seconds. He comes on stage with a cat. What is this? He's not going to be late. He's going to be on time. We already got that. Risks in favor, risks to downside in labor. Let's see. He uses paper instead of iPad. I'm gonna go paper instead of iPad. And the last one. Come on. We have not discussed the next meeting. Yeah. Next meeting will be live. We'll talk at that. We'll say that. Next meeting will be live. They like that word. Okay. All right. Ready? Take a screenshot of this. Take a screenshot of your bingo board. All right.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Let's listen.
What the hell is
Our
this?
economy is strong overall and has made significant progress toward our goals over the past 2 years. Maximum employment and stable prices for the benefit of the American people. Overheated state. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. 2.2%. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%.
That's basically declaring victory.
As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed that made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the 2 employment reports, July and August. We've also had 2 inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year.
They're next to each other.
Does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher than long? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
By the way, in honor of the 50 basis point cut, we are doing a 24-hour flash sale. Meet Kevin.com, Stocks and Psychology Money Group.
How close was this in terms of the decision? You do have the first dissent.
See my $2.5 million call option trade on this Fed 50.
Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of opinion, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right?
Wow.
7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Yeah, 4 or more. That's my guess.
This is in the books. Can you give us some guidance as sort of
Turn his mic on.
The pacing here? Would you expect this to be running every other meeting once we get into next year? For example,
we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina. Hi, Chair Powell. Gina Smilik, the New York Times. Thanks for taking our questions.
There she is.
You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see
that's why 50.
Rising, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Okay. Right here, he's hawkish by suggesting economy is strong now.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. But so I would say we don't think we're behind. We do not think we're behind. We think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred
Good job,
about
Nick T.
How the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Okay, it's another tool.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, you know, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Okay, fair.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, you know, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment
I
rate.
knew they would do that.
Anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, you know, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, you know, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person as measured. It's now below around 1, but that's still a very good number, I would say. You know, quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, you know, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
You know, more data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. You know, it's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Hi, Chair Powell. October 4th jobs report, November 1st jobs report, October 10th CPI, November 13th CPI. Write those down.
Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, you know, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs,
immigration,
you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I mean, I think we are, it's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Quick shout out to those of you taking advantage of the Fed flash sale in honor of 50. Sergio, Matt, Ruben, Jacob, Francisco, Josh, Nicholas, thanks for joining the Stocks and Site group. Lifetime access, you pay once at meetkevin.com. 24-hour flash sales on now.
Has experienced zero or near zero federal funds rate. Now some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this?
Yeah.
It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But, honestly, we're going to find out. But, it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. Again, we only know it by its works.
One more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so, this is my fourth presidential election at the Fed, and, it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve. And we do that, and we make a decision as a group, and then we announce it. And that's always what it is. It's never about anything else. Nothing else is discussed. And I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene. Thank you, Chair Powell. I'm Jolene Kent.
NASDAQ just went negative, and things are starting to fall now, which I kind of suspect that there might be profit taking after this meeting. It's kind of what we predicted. Anyway, you want more of my insights and trades and ideas, my $2.5 million call options, meetkevin.com, flash sale.
And our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. You know, do you think you can return to 2% with housing inflation where it is?
Yep.
Yeah.
So
let's see.
Housing inflation is the one piece that is kind of dragging a bit, if I can say.
Yes.
We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, you know, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, you know, the direction of travel is clear. And as long as market rents remain, you know, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just 1 or 2 cycles of annual lease renewals. So that's, I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. You know, they all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more.
Inventory will go up.
You know, what's the likelihood of that, and how would you react to that?
We don't know.
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home. So
watch this. Inventory goes up.
Mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not, you know, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more difficult. And, you know, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria. Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, you know, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much.
There is a lot of profit taking happening right now. Like everything's just kind of turning red right now.
To run versus just the labor market is strong. And then also if I...
It's 10-year profit taking, by the way, for those of you wondering why the yields are going up.
Do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, you know, business people who are actually out there doing business. So I think, you know, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, you know, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but you know, we might well have. I think that's not, you know, that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday, after the CPI number came out? It was a really small probability.
Before Nikki leaks.
Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world.
Here we go. The whole Venezuela argument about this is what kills countries when politicians have control over monetary policy.
People have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we're not, we do our...
Right, because there's deemed to be more trust, blah, 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 blah. A shout out to somebody you just signed up again on the Fed flash sale for Fed 50. Charles signed up for a bundle here, gold and stocks and psychology money group. Awesome. Ding, Marjana, Pedro, Jesus, Sunil, Matthew, Akshay. I may have messed that one up. Anyway, thanks for signing up to that. Remember, we're also now starting personal wealth advising, actual financial advice all year long. For the years going forward, we can build a relationship with you and help you manage your wealth over at stockhack.com. We're launching that service within the next week and a half. So get in line over there if that might be of interest to you by signing up at stockhack.com just to be on the interest list.
The Basel III Endgame. I'm wondering if you are...
Oh, the flash sale is meetkevin.com, by the way. Stocks and Psych Group. You get to see my $2.5 million bets and how I'm going to reposition, what I do, and stuff like that.
And if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators...
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So the answer to your question is that, yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Is there a date for that?
It's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then the comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
And then yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. That the stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today was, I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn, is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
Wow. Okay, we need to do a whole summary of all of this. This is amazing. This is a lot to unpackage here. The first rate cuts have begun. Well. Thank you so much, first of all, for being here and watching it with me. Meet Kevin. Let's do a summary of everything that we just discovered here. Shout out to those of you, again, signing up for the Fed 50. I made a bet that we're going to get 50 basis points of cuts. We talked about the plan this morning. We'll see how it plays out. We'll see how we're repositioned. We expect profit taking in the markets across the board after this event. And then tomorrow and the next day and quite frankly into next week, I think we're going to see a real rebalancing in markets here where markets are going to go, damn, we know they're saying they're not declaring victory on inflation, but they kind of are. We know they're saying we don't see anything that would cause a recession. Duh! Dude, imagine if he came out and said, hey, we see a recession on the horizon. You'd cause the recession. You would literally single-handedly cause the recession by admitting it. So I think you're going to have a lot of recalibrating by investors here. You're going to have a lot of people that are like, okay, all right, well, damn, we were not expecting 50, so let's take some profits on some of the moves we've had over the past few weeks and kind of see where do we go from here. So I think that's kind of where we sit right now. Let's do a full summary of what's going on here and then kind of analyze the markets a little bit. Quick reminder, thank you so much for those of you signing up for Fed 50 on Stocks and Psych. You get lifetime access to the course member live stream. So every single Fed meeting for the rest, as long as I sit here and do YouTube, which I expect to do for a very, very long time, it could be 20 years, you get to see my analysis in those course member live streams and moves I'm making. So even if I'm wrong now, although we were right about 50, even if I'm wrong now, you get to see other predictions in the future, and we love doing this every single day. So join those course member live streams. Pay once, you're in forever. Okay, let's get started. So let me hit the little record button. Well, holy smokes, it is official. The Federal Reserve rate cuts have begun. Expect to get some emails in your bank account suggesting, hey, it's your banker. Your savings rate is now down by 0.5 percentage point. Now, Jerome Powell calls this a recalibrating of policy. And one of the things he left off with is suggesting that he sees no indication that we are presently in a recession, at the same time as he also suggests we're not willing to declare victory and we are not declaring victory on inflation. But both of these, in my opinion, are straight up lies. I think that the Federal Reserve is declaring victory on inflation. I'll show you that on the summary of economic projections in just a moment.
Not only do I think the Federal Reserve is declaring victory on inflation, but I think the Federal Reserve realizes if they came up in front of a nationwide audience and said, yeah, there's some recession risks, you would see the market so quickly sell off that you would literally create the very recession you are trying to avoid. This is why, of course, Jerome Powell says, quote, "I don't see anything in the economy that suggests the likelihood of a downturn is elevated. We don't see that. You see growth at a solid rate. You see the market very solid. I don't really see that." That was his line on recession. But wait a minute. Let's take a look at the summary of economic projections. Does that align with what your staff is thinking? Because, see, in this summary of economic projections, what I've done is I've compared the March 2024 estimates y'all gave to the current estimates for next year. And in March of 2024, we had a low estimate for the 2025 GDP of 1.9%. Right now, that low estimate has moved to 1.3%. Note, that's the range, right? They expect it'll be average around 2%. But someone at the Fed thinks it could go as low as 1.3. The lowest low estimate was 1.9. Now it's 1.3. The Fed sees the weakening in GDP. Notice Jerome Powell did not once suggest, the Atlanta Fed real GDP says GDP is growing at 3%. Why wouldn't he mention that? He doesn't mention that because that is extremely misleading and would send a signal that they're blind. Instead, he says, GDP is progressing at roughly the similar pace now as it was at the beginning of the year at about a 2.2 percentage point pace. Interesting. So if GDP is expanding at 2.2%, and you think there's this downside risk, we could go potentially, somebody at the committee thinks we could go as low as 1.3, which again, the previous low was 1.9. And the previous low for the unemployment rate was 4.2, and now it's 4.7 the previous high estimate was 4.2 for 25, and now it's 4.7. It kind of suggests that there's some folks over at the Fed that are going, no, things are weakening more than we expected. And Jerome Powell did indicate that in this meeting as well. He tells us very clearly, hey, the jobs market has started to weaken substantially, especially when we look at job openings. Now, Jerome Powell is trying to put a floor under that. Think about kind of like a line on a chart plummeting, and he's trying to put like a support underneath, like on a stock. It's like, okay, how can we stop the collapse? That's why we got a 50 basis point cut today. They're trying to put a floor under that labor market slowdown. But it actually makes me nervous, and I'm going to give you my predictions for what I think is going on. And I'll show you what my predictions were going into this, and we'll check those. But first, in honor of being right on a 50 basis point cut, I told my team we would not do this unless I was right on 50 basis points. We went from having no coupon to having a Fed 50 coupon. So in honor of being right, for being basically one of the few to suggest 50 basis points, 9 out of 115 Bloomberg economists thought we were going to get a 50 basis point cut. We got a 50. A lot of people were like, you're crazy thinking 25. Anyway, I was thinking 50. People thought I was crazy for thinking 50. We got 50. And so we did a flash sale. It'll expire tomorrow at lunchtime. It's kind of weird time for it to expire, but 24 hours basically. Fed 50, go to meetKevin.com. You get lifetime access for life to all my trades, including my $2.5 million in call options, other allocations that I'm making, where my head is on real estate, the real estate market, the stock market, future Fed meetings. It's not like you're just buying now to see, okay, what's Kevin doing right now? You get that lifetime access. So consider that by going to meetkevin.com. But let's compare some of the other things that were said. First of all, we have the following. My predictions going into this were that we were going to get a 50 basis point cut. We got that. We are not currently in recession. We got that. And of course, the Fed wants to be vigilant and that rates are sufficiently restrictive. We got that. The Federal Reserve did project a higher terminal rate than I expected, 4.4. I was looking for 4. And profit taking ensues. We'll have to really see how things move over the next couple days to see how profit taking ensues. So far, it seems like there was some profit taking, but we're trying to get back to that 476 line on the NASDAQ 100. So we'll see where that goes. Now, something I want to point out to you is over here on the FOMC statement. Look at this. Right here, they projected a 4.4 at the end of the year, which is a substantially greater set of rate cuts than what we had in the last FOMC projection. And if we jump to that last projection, you can see that I wrote here, if we get less than a 4.6, we're going to get a 50. And that's exactly what we got here. We got a 50 basis point cut because I think the Federal Reserve is starting to recognize there is weakening, but we don't want to panic anybody. So we're going to have a hawkish conference, right? We go 50, have a hawkish conference. The economy is fine, no recession, everything's fine. He literally said, the economy is fine. Those were quoted. I saw it even pop up on terminals. People were like, Powell, U.S. economy is fine. And it kind of just reminds me of like that cartoon meme where, you know, the guy's sitting there with the coffee. Everything is fine and everything is on fire right behind him. Consider for a moment why they ended up cutting 50. They not only used the incoming payrolls data and suggested that maybe had they had this data earlier, they would have actually cut 25 in July. But they also said they're starting to see anecdotal warnings in the Beige Book of weakening in the various different bank sectors throughout the United States, that is Fed member bank sectors.
Hey everyone, thank you so much for
that's
considering
why
this
they
program.
cut 50. They're trying to, they don't think they're behind, they don't want to fall behind, but they also acknowledge that they're not in a rush to get this done, that they're going to remain data dependent. This is not surprising. But listen to this. All 19 members at the Federal Reserve who were part of this decision, 12 of them vote, but 19 are part of it. All of them part of the Summary of Economic Projections. All 19 wrote down multiple rate cuts for this year. Just in the last Summary of Economic Projections, very few were writing in multiple. In fact, there was a talk that we would only end up getting one rate cut this year. 17 officials wrote down 3 or more cuts. 10 out of 19, so more than half, wrote down 4 or more cuts. Jerome Powell says the economy is in good shape and the labor market is in a solid position. He does actually compare the labor market. I was worried they were going to do this as a way of being hawkish, and they did. We warned about this in the days before, and they pulled it out of the bag. I was worried they were going to say, well, historically, 4.2% unemployment is really low. That's bad. You don't want Powell going, oh, well, 4.2 is historically low, because it potentially means they're willing to be a little bit more cavalier with that jobs market because it seems like it's in a good place. But once the economy starts slowing, it's an inertial movement that's hard to stop. This is why Powell was asked, hey, usually when the unemployment rate goes up 1%, it proceeds to go on yet another 1 to 2 percentage points after that. Isn't that bad? And Powell says, well, that's why we're going 50 to try to stop it now. So he recognizes the trend is down on unemployment. They're trying to stop it with 50. But in the same conference, he also said, well, we're not political because after all, there's a lag in, how long it takes for rate cuts to hit the economy. Okay, cool. So the federal, unemployment rate is at a level where you want it now, but your rate cuts are going to lag to help the unemployment rate. So in other words, the unemployment rate might actually weaken further, might rise further before your rate cuts even take effect. Jerome Powell basically declares victory by suggesting that our patience has paid dividends. The base case is getting to a more neutral level. They're right now pricing in rate cuts of about 200 basis points, would take us to about 3.25% into the end of 2025 through this easing cycle.
Prop firm, so on and so forth. We had someone crack almost 11,000 yesterday. These are all of these are going to be US dollar, no matter what the market says here. So take that for what it's worth as well. Amex and NASDAQ. So again, someone that would maybe trade the spiders or something like that would be part of that, as well as NASDAQ, and someone in Canada. So lots of opportunities north of the border for anybody looking at that again. And I know, again, our campus program has a lot of Canadian trading in that as well. NASDAQ, Amex, NASDAQ, Canada, So we don't have anything there as far as Europe is concerned from yesterday, but the top Vienna trader right there made 1,800 on that market, but must have lost it somewhere else, right? Oh no, 1,800 doesn't make this list. So right there, 1,800 in Vienna. The NYMEX, someone traded natural gas or oil, Zetra market there. The CSE Hong Kong Mexican market as well. So grab those pesos and get going. But right now, that's where the profit brought to you by yeah, real trading. So every market talked about there. If you're part, someone on the chat is talking about they're in the demo. They really like everything so far. So yeah, thanks again for that. We'll pass on.
I can't lie. I actually forgot that we'd added the the markets in Mexico. Brazil
avocados and everything?
Traded Brazil before. Avocado prices are
skyrocketing.
They're no joke. They're no joke. My daughter freaking loves avocado. Like that is one of those go-to.
You could put avocado in shawarma, you know.
Oh, heck yeah.
That elevates the shawarma party.
Look, it takes the shawarma party to a whole.
Yo, Ramin knows all the hot shawarma places. Ramin, let's order shawarma. We got some super chats.
Friday shawarma.
Friday is shawarma day.
Shawarma and Corona.
Yeah.
Sharona? My Sharona?
My
No.
Sharona? Is it a Sharona day on Friday?
Why not? We used to do
I'm
the
not-
brews on Fridays.
Yeah.
I don't know how we got away from that.
I'm right here.
Well, you weren't here the last couple. See, that's what happens, man.
What did you guys have?
No, we didn't do
Sharonas?
it. No, so the last time we had beers on the
better not tell
Friday,
my kids we had.
you weren't here, and I was literally drinking by myself because.
Oh, Obi wasn't participating.
No, which is fine. I'm not trying to pressure anybody in anything.
No,
You just
that's
didn't
fine.
feel like having
We'll have it.
so.
We'll have it.
Let's do it.
Someone will send in some Coronas, and if not, we'll send
the boys out to get some.
somebody to go get it, anyways.
No.
One avocado does more damage to the planet than my 30-year-old truck does. Anyways.
No.
Send in some Coronas, and if not, we'll send
the boys out to get some.
somebody to go get it, anyways. So the TQ's there. The TQ's there at it might be true. I have no idea. We got stopped out there once we broke through VWAP. Really happy, really happy with that one there. I don't know. I mean, I don't grow any avocados. I don't know why they would harm the world there, but that individual might. I mean, I do know how petroleum does. Okay, move to the downside. I was looking at Amazon. I don't know. I feel like now we can just actually trade. The market is digested whatever moves. I think it needs to now. Powell's gone. I didn't hear too much from Brendan there that would surprise.
Nothing
I mean,
earth-shaking.
remember when we started this whole thing? Where was the market? Oh yeah, right here. I'm glad that we've traveled up and down and able to make money in this market. But as I look, this is where the futures were at 2 o'clock. 19,700. Where are we now? 19,692. So we're actually flat on the market, if not a little bit down right now. We've roller coaster ride, man, but all these are good. These are shorts, these are longs. We lost into here. We talked about that. This was sketchy, and then that happened. So, yeah, good day, 335 today right now, 25 minutes left. You already showed the imbalances. Plus, this week, this is the third Friday, right? So we do have quad witching. It's quad, right? If not more than that, coming up on Friday, where we'll have more imbalances to come through and more exciting trading. So we did get that 50 basis points. I think it's all clear long. I think tomorrow is going to be a huge long day. If anybody's asking me, I know nobody is, but I think that you could swing everything long tomorrow and hopefully thank me in the morning. If not, yeah, good luck to shorts. I don't know. All I do is trade, man. So, we'll go, like I said, we put on 8 names today. We'll go 8 for 8. And yesterday, I think 7 and 1. It's just been a really good run. We're really reading the markets really, really well. They said go to Neil. So Neil?
Yes, sir. And this afternoon, all the crazy action here brought to you by our good friends at Moomoo. Shaking up the investing game with its cash sweep program, offering an incredible 8.1% APY on uninvested cash, far surpassing typical stock returns. Your cash earns interest 24/7, and you can access it anytime to reinvest when the market turns. Plus, sign up now and snag 15 free stocks and bonuses up to $2,300 in Canada. Don't let your money sit idle. Make it work for you. Shout out to Moomoo. Scan that QR code below. Check the link in the description of this video. That's a good return for you. But now this market really is heading back into the downside. Kind of got away from the shorts and was looking for these imbalances to maybe come out. It might have been a bit of a mistake, but I'm just looking. You can hope all you want, but the litmus I was looking for IWM was, hey, hold on to the previous day high. It's been doing that the entire time. If it can't do it and we get a 50-point cut, that's not going to bode well. What you don't want to see are false breakouts and reversal candles, because those are the kind of things that trend you back into prior support, whether that's 16 or 14 here. Just double checking where we have been with the short. A firm goes with really a VWAP retracement. That's what it's going to do. Every now and then, VWAP is a line on a chart that gets respected to the penny. I can tell you that is exactly what happened here on a firm. It went right to VWAP, to the penny, and just pulled right back in. I don't know that I want to take this one more time. I feel like Powell ran on a little bit longer than we're used to in here. And as day traders, we're going to be flat at the end of the day. I do want to remind everybody that just because the market closes at 4 o'clock, if you're new here, we're staying till 4:30. The traders are going to stay late. We got Chris Brecher going to come through. Going to make sure, actually have to make sure that usually he's confirmed by now, but he'll be good to go. And we're going to be able to talk all about what happened with the Fed. Forget about earnings. There's nothing important that's going to be dropping in front of earnings, but we're going
to. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
So the US is not going to a recession. Ladies and gentlemen, wow, that is level 1000, just cut the stream and that's it. Oh my days. I can't believe that. He just practically told everyone, that's it. No recession. I just walked off. That was what an exit. So, ladies and gentlemen, first things first, let's just have a look at what's going on. Bitcoin makes a nice little move up. Now the markets are pretty much solidified. NASDAQ itself is now trading lower. Stock run to the upside. Couldn't quite take the 20K. S&P itself at the all-time highs to only reject that point. Looking at the dollar dominance, it made the move up. Now it's still in that exact same zone. So effectively, the FOMC itself was just a waste of time. We saw a little bit of movement, but now we're going to see the true flavor of what is going on in the charts. So with that being said, ladies and gentlemen, moving forward, okay? You're all going to start seeing the news articles that are coming out on people's opinions on what they think is going to happen next. He just told us that we're not in a recession, that the US economy is strong and everything's all good. Employment rate is doing fine at these low levels, which is true. It's only at 4%. All right. If it was at 6%, we'd have a different story, but it's been the lowest for over 50 years. All right. Now, Biden would take his claim to that, saying that was because of him. Okay, cool. But looking at where we are right now, we have still got the Japanese to come into play, okay? And quite frankly, that meeting itself for me, it just basically, it kicked ass in the sense where, yep, we gave you your rate cuts, happy days. The economy's doing fine. 5 months worth of contraction in the manufacturing sector, which is what I was looking for earlier on. How is it that the economy is doing fine? That it's contracting for 5 months. Where is it? Where is my manufacturing index? Here we go. Flash PMI. Not that one, not the ISM, although that is the best one to look at, to be fair. It's not consistent. It's just 50, then down, 50, then down, 50, then down. It's just, even the actual other manufacturing sector, it's, what's that doing there? Yeah, it's just not making sense. How is he saying that the economy is fine and we're not going into recession? It could be motivated by the election, all right? So, did you enjoy that, ladies and gentlemen? Firstly, mad love and respect to everyone who's liked the stream. We've nearly hit 3,000 likes, so that'll be happy days. And of course, guys, if you are new to today's live stream, I won't be going live tonight because this is your live stream in principle. But we will be going into the Asian session this evening, and they too will get the initial reaction to what has happened today, all right? Moving on, if you are new, get over to tradersreality.com. We've had a decent live stream today. Really happy with it. We've had a lot of flavor going off in the charts. But just make sure now that we know where we stand with the interest rates, now we can start trading properly. The biggest event has happened, so we don't need to worry about anything else other than the Japanese yen. So be sure to like and subscribe. Check out tradersreality.com, and everything that we've mentioned in this live stream is in the description. Mad love and respect. Have yourselves a wonderful evening, guys, and I'll catch up with you tomorrow.
This is the Asia Trade. I'm Chevryan in Tokyo.
I'm Heidi Stroud-Watts in Sydney.
You just get that? Oh.
Weakening, that's anecdotal, right? Those are leading indicators. So I don't think it's all Gucci out there. I think the Fed is doing the right thing by going 50. So I probably on the bull-bear scale, bear-bull scale for those of you wondering, I said that 50 would be more bullish. I did kind of anticipate 50, so I went to 3.5 on the bear-bull scale. I'm probably at like 3.6 right now, but it's not where I'm like so excited about where valuations are in markets and where I am. But yeah, I mean, like, do I smidge up a little bit because of this on the bear-bull scale? Fine. But, 3.6 is certainly not making me want to run into stocks going like uber bullish all in on margin right now, That recession risk is still very, very present. And I think it becomes substantially more evident and prominent over really the next 4 months here, especially January, like a January layoff period. If you get a bad October, January layoffs could be bad. So, those are just little things to watch for. So on bear-bull scale, 3.6. So that's my take. Anyway, if you don't already know, by the way, you could watch totally for free my market open live streams every day the market is open over at the Meet Kevin live channel, Meet Kevin Market live channel on YouTube or on X. You can follow me on Instagram at RealMeetKevin, and that's all I got. So meetkevin.com, 24-hour flash sale on the Stocks and Psych group and the other courses if you want to bundle up. If you have questions, staff at meetkevin.com, stockhack.com. Get in line for the financial advice if you're interested in that. And good luck, everybody. I really do appreciate all your support. I couldn't be here without you. And all I can promise is that every single day, I'm going to do my best to just keep working hard for you, even if I F up. So appreciate y'all. Thanks, folks. Goodbye.